Before we dive in, please remember that I am not a financial advisor, loan officer, or real estate agent. This presentation is for informational and educational purposes only. The home loan process is complex and individual situations vary greatly. You must consult with a qualified and licensed professional, like a VIS specialist lender, before making any financial decisions. You served your country, you stood on that wall, you did the job, and now you want your piece of the American dream. A home to call your own. But maybe you've looked at your bank account and thought, how am I ever going to save 20% for a down payment? Maybe you've heard horror stories from buddies about lenders who don't understand military life, who see a PCS move as instability, or who just don't get the VA loan. You feel stuck. You feel like the one benefit designed specifically for you is locked behind a door, and no one will give you the key. I'm here to tell you that door is about to be kicked wide open. The VA home loan is, without a doubt, the single most powerful mortgage product on the planet, and it was earned by you. It's not a handout, it's a handshake. A thank you from a grateful nation. And over the next few minutes, we are going to demystify this entire process. We will break down every single requirement, step by step, in plain English, so you can walk into a lender's office with the confidence of a seasoned NCO. By the end of this video, you will have a crystal clear roadmap to getting pre-approved for your VA loan. No more confusion, no more myths, just facts and a clear path forward. So why do I call it the most powerful mortgage on the planet? Let me give you the big 3 reasons. First, and this is the one that changes everything for most people, 0 down payment. Let me say that again. In a world where conventional loans demand you bring tens of thousands of dollars to the closing table, the VA loan allows you to finance 100% of the home's value. This isn't some special first-time buyer program with a million strings attached. This is the standard. This is your benefit. Think about what that means. You can get into a home and start building equity, start building a life for your family years sooner than you ever thought possible. Second, you will never pay private mortgage insurance or PMI. With a conventional loan, if you put down less than 20%, the lender forces you to pay an extra insurance premium every single month. It's basically insurance that protects the lender, not you, and it can add hundreds of dollars to your monthly payment for years. With a VA loan, no PMI, ever. That money stays in your pocket where it belongs. It goes towards your kid's college fund, a new car, or paying down your mortgage faster. It's a massive ongoing savings that most people completely overlook. And third, the VA loan typically comes with some of the most competitive interest rates on the market. Because the Department of Veterans Affairs guarantees a portion of the loan, lenders see it as a lower risk investment. That lower risk for them translates into a lower interest rate for you. Over the life of a 30-year mortgage, even a fraction of a percentage point can save you tens of thousands of dollars. So let's recap. 0 down, no monthly mortgage insurance, and a lower interest rate. That's a financial trifecta. It's a wealth-building tool that you have earned through your service. But I know what you're thinking. Sounds too good to be true. You've heard the myths. VA loans are slow and full of red tape. Sellers won't accept a VA offer. My credit isn't perfect, so I can't qualify. I used my VA loan once before, so I can't use it again. I'm here to tell you that 99% of what you've heard is either completely false or wildly outdated. And we're going to bust every single one of those myths. To do that, we need a framework. The entire VA loan qualification process boils down to 3 fundamental pillars. Think of it as a 3-legged stool. If one leg is weak, the whole thing wobbles. But if all 3 are strong, you're rock solid. Pillar number 1 is your service. This is the foundation. You have to be an eligible veteran, active duty service member, or qualifying surviving spouse. This is all about proving you've met the minimum service requirements. Pillar number 2 is your financial profile. This covers your credit, your income, and your debt. The VA wants to see that you have a stable, reliable income and a history of handling your financial obligations responsibly. And pillar number 3 is the property. The home itself has to meet the VA's minimum property requirements, or MPRs. They want to ensure the home you're buying is safe, sound, and sanitary. That's it. Service, financials, and property. Every single rule, every piece of paperwork, every question a lender will ask you falls into one of those 3 buckets. And today we are starting with the absolute first step. Pillar 1, your service. Before a lender can even look at your credit score or your pay stubs, they need one crucial document. This is your golden ticket. It's called the Certificate of Eligibility, or your COE. The COE is an official document from the VA that tells the lender, yes, this person has met the minimum service requirements and is eligible for the VA home loan benefit. Without it, you can't move forward. So, the big question is, who is eligible? Let's break it down by category. First, let's talk about our veterans. The rules here are based on when you served. For those who served during wartime periods like the Gulf War, the requirement is generally that you served for at least 90 consecutive days of active duty. For those who served during peacetime, the requirement is typically 181 continuous days of active duty. And for anyone who enlisted after September 7, 1980, or entered service as an officer after October 16, 1981, you generally need to have served 24 continuous months of active duty. Now, there's a huge exception to all of these rules. If you were discharged for a service-connected disability, you are eligible regardless of how long you served. Even if it was one day, you served, you sacrificed, you're eligible. Period. Next up, are active duty service members. This is simple. If you are currently on active duty, you are eligible after you have served for 90 continuous days. That's it. You don't have to wait until you get out. You can buy a home for your family right now, at your current duty station. What about our citizen soldiers and airmen in the National Guard and Reserves? For a long time, this was a gray area, but the rules are clear now. You need to have 6 credible years of service in the selected Reserve or National Guard. Once you hit that 6-year mark and you've got your retirement point statement, you're good to go. There are also exceptions here. If you were called to active duty under Title 10 or Title 32 orders, the active duty rules of 90 consecutive days may apply to you. So if you were mobilized for a deployment, you likely became eligible much sooner. Finally, and this is so important, let's talk about surviving spouses. This is a benefit that is tragically underutilized because many people simply don't know it exists. You may be eligible for the VA loan benefit as a surviving spouse if your spouse died in service or from a service-connected disability. You may also be eligible if they were missing in action or a prisoner of war. The key here is that, in most cases, you cannot have remarried. This benefit is a way of honoring your family's ultimate sacrifice, and it can be a lifeline. So you've listened to this and you've said, yes, that's me. I meet those requirements. How do you get your hands on that golden ticket, the COE? You have 3 main options. Option 1, the easiest and fastest way, is to let your lender get it for you. A good, experienced VA lender has access to the VA's online portal. They can typically pull your COE for you in a matter of minutes. All they usually need is your date of birth and social security number. This is why working with a VIS-savvy lender is so critical from the very beginning. Option 2 is to get it yourself online. You can go to the VA's e-benefits portal, log in with your credentials, and request it directly. It's a straightforward process, and the document is usually available for you to download almost instantly. Option 3, the old-school snail mail route, is to fill out VA Form 26 to 1880 and mail it in. This is obviously the slowest method and can take several weeks, so I only recommend it as a last resort. Your service is the bedrock of this entire benefit. It's the key that starts the engine. And as you can see, the requirements are broad and designed to include as many service members and veterans as possible. The system is set up to get you to yes. Now that we've firmly established Pillar 1, and you know exactly how to prove your eligibility, you're ready for the next step. But this is where most people get nervous. It's where the myths and misinformation really start to fly. We're talking about Pillar 2, your financial profile. We're talking about credit scores, income, and debt. What is the minimum credit score the VA really requires? The answer is going to shock you. The minimum credit score the VA requires is none. 0. Zilch. The Department of Veterans Affairs, the organization that backs your loan, sets no minimum credit score whatsoever. And that is where the chaos begins. Because while the VA is willing to guarantee your loan, they aren't the ones actually handing over hundreds of thousands of dollars. The bank is. The credit union is. The mortgage lender is. Think of it this way. The VA is like the world's best co-signer. They're telling the bank, hey, this veteran is a good bet. If for some reason they can't pay, we've got your back. But the bank, being a bank, still wants to do its own due diligence. They're the ones with the money on the line, so they get to set their own rules. And their number 1 rule is managing risk. This is what we call a lender overlay. It's an extra rule the lender puts on top of the VA's guidelines. So while the VA says go, a lender might say, hold on a second. In the real world, you'll find that most lenders are looking for a minimum credit score of around 620. Some are more flexible, maybe going down to 580. A few might not even have a hard minimum, but they'll scrutinize every other part of your file that much more closely. But here's the secret the best loan officers know. The 3-digit score itself is just a headline. What the underwriter, the person who actually approves or denies your loan, truly cares about is the story your credit report tells. Are you paying your bills on time every time? That's the single biggest factor. Do you have collections accounts, charge-offs, or judgments? Those are red flags. The VA is incredibly forgiving, more so than any other loan program, especially when it comes to major financial setbacks. Let's talk about the big ones. Say you had to declare bankruptcy. For a conventional loan, you might be waiting 4 years or more to get a mortgage. With a VA loan for a Chapter 7 bankruptcy, you can be eligible just 2 years after it's discharged. For a Chapter 13, you might be eligible after making just 12 on-time payments within the bankruptcy plan, and you might not even have to wait for it to be discharged. What about a foreclosure? Again, the VA is more lenient. The waiting period is typically just 2 years from the date the foreclosure was finalized. Compare that to 3 years for an FHA loan or a staggering 7 years for a conventional loan. The underlying theme here is that the VA understands that life happens, especially to service members and their families who face unique challenges like PCS moves and deployments. They want to see that you've recovered and reestablished good credit habits. A single bad event from years ago is not a life sentence. A consistent pattern of late payments last month? That's a much bigger problem. So, Pillar 2 isn't just about credit. It's a 3-legged stool: credit, income, and debt. We've covered credit. Now let's talk about income. The VA doesn't have a minimum income requirement. You don't need to make 6 figures to buy a home. What you need is income that is stable, reliable, and likely to continue. Let's break that down. Stable and reliable. For active duty service members, this is easy. Your LES, or Leave and Earnings Statement, is the golden ticket. It shows your base pay, your BAH, basic allowance for housing, your BAS, basic allowance for subsistence. All of it counts. And here's a pro tip. Your BH can be used to qualify even though you'll stop receiving it once you buy the house. The lender uses it to offset the new mortgage payment. For veterans, it's about showing a consistent work history. The general rule of thumb you'll hear is 2 years. But this is another area where myths run wild. It does not have to be 2 years at the same exact job. The VA is looking for 2 years of consistent employment, preferably in the same field. If you're transitioning out of the military, this is huge. You don't need a 2-year civilian work history. Your time in service counts. If you have a solid job offer letter for a position that starts within 60 days of closing, that can often be used to qualify. What else counts as income? Almost everything, as long as you can document it and prove it's likely to continue for at least the next 3 years. VA disability compensation? Absolutely, and it's tax-free, which gives it more weight. Military retirement pay? You bet. A part-time job you've had for a year and a half? Yes. Social Security income? Yes. The key is documentation and consistency. Now for the third leg of the stool, the one that ties it all together, debt. This is where we get into the numbers, and it's where the VA loan has a hidden superpower that most people, even some lenders, don't fully understand. You've probably heard of the debt-to-income ratio, or DTI. It's a simple concept. You add up all your monthly debt payments, car loans, student loans, credit card minimum payments, and your future estimated total mortgage payment. Then you divide that total by your gross monthly income. The result is your DTI percentage. For most loan types, DTI is a hard, unforgiving wall. If the limit is 43% and you're at 43.1%, you're denied. End of story. The VA has a guideline that they prefer to see a DTI of 41% or less. And that word, guideline, is the most important word in the sentence. It is not a rule. It is not a hard stop. Veterans get approved with DTIs of 50%, 55%, even 60% or higher all the time. How is that possible? It's possible because of the VA's superpower, residual income. Residual income is the secret sauce. It's the metric the VA cares about more than anything else. While DTI is a blunt instrument, a simple ratio, residual income is a nuanced real-world calculation. It asks a very simple question. After you pay your new mortgage, your property taxes, your insurance, your car loans, your credit cards, and your estimated utilities, food, and clothing, how much money do you have left over at the end of the month? That leftover money is your residual income. It's your financial safety net. The VA has a chart that specifies the minimum amount of residual income you need to have. And it's based on your family size and the region of the country you live in. Let's make this real. Imagine a veteran, we'll call him James. He has a family of 4 and lives in the Midwest. His gross monthly income is $6,000. His debts are a $400 car payment and a $100 student loan payment. The new mortgage on the house he wants to buy will be $2,000 per month. So, his total monthly debts are $400 plus $100 plus $2,000 equals $2,500. His DTI is $2,500 divided by $6,000, which is 41.6%. He's just over that 41% guideline. A nervous lender using a standard formula might stop right there. But the VA underwriter goes a step further. They calculate his residual income. They start with his gross income of $6,000. They subtract federal and state taxes, maybe about $1,200. That leaves him with a net income of $4,800. Now they subtract his debts, the $2,500 mortgage and other debts. He's left with $2,300. But they're not done. They estimate his monthly living expenses. For a 2,000 square foot home, they might estimate $280 for utilities. They also subtract a maintenance figure. So let's say after all that, James has $1,800 left over. Now the underwriter looks at the VA's residual income chart. For a family of 4 in the Midwest, the minimum required residual income might be, say, $1,003. James has $1,800 left over. He is crushing that requirement. He has a significant financial cushion. To the VA, this is a green light. The DTI of 41.6% doesn't matter nearly as much as the fact that James has almost $800 more in his pocket each month than the VA's minimum safety net requires. This is a loan that is likely to be approved. This is why the VA loan is so powerful. It looks past simple ratios and focuses on what truly matters: your actual real-world ability to afford your home without financial distress. This financial pillar, your credit, your income, your debt, and your residual income, is the most complex part of the process. It's where a great loan officer earns their keep, helping you navigate the guidelines and tell your financial story. But it's only one piece of the puzzle. You can have a perfect credit score and a 6-figure income, but if the house itself doesn't meet the VA's standards, the deal will still fall apart. That brings us to Pillar 3, the property. We're talking about appraisals, inspections, and the VA's infamous minimum property requirements, or MPRs. What are they, why do they exist, and how do you keep them from killing your dream of homeownership? We'll break it all down next. So let's talk about these minimum property requirements, or MPRs. Think of them not as a roadblock, but as a suit of armor the VA gives you before you go into the battle of homeownership. The VA is guaranteeing a portion of your loan, putting its own skin in the game. In return, they want to make sure the house you're buying isn't a money pit, a safety hazard, or a total lemon. They're protecting their investment, sure, but more importantly, they are protecting you, the veteran. They want to ensure you're moving into a home that is, at its core, safe, sound, and sanitary. Those 3 words are the pillars of the VA MPRs: safe, sound, and sanitary. Let's break down what that actually means in the real world. First, safe. This is about protecting you and your family from immediate harm. We're talking about the obvious stuff and some things you might not even think about. The home must have a roof that's in good shape and doesn't leak. It can't have exposed electrical wiring, broken windows, or missing handrails on staircases. If the house was built before 1978, it must be free from chipping or peeling lead-based paint. The heating system has to be functional and able to maintain a temperature of at least 50 degrees Fahrenheit. The property can't have any conditions that would endanger the occupants, like being too close to a high-pressure gas line or in a known geological hazard area. It's all about ensuring the basic physical safety of the home. Second, sound. This refers to the structural integrity of the house. Is it going to fall down around you? The VA wants to know. The foundation must be solid, without major cracks or settling issues. There can't be evidence of ongoing water damage or dry rot. And a big one: the property must be free from wood-destroying insects like termites. The appraiser will look for evidence of termite damage, and in many parts of the country, a separate pest inspection is required. The property also needs to have proper drainage, so water flows away from the foundation, not into your basement. Basically, the bones of the house have to be good. And third, sanitary. This is about basic livability. The home must have a safe and reliable water supply with both hot and cold running water. It needs a working permanent toilet, shower, or bath. The sewage disposal system, whether it's a public sewer or a septic tank, has to be in good working order and safe. There must be adequate space for you and your family to live, cook, and sleep. This also means the property needs safe access from a public or private street. You can't buy a landlocked property with a VA loan. Now you might be thinking, that sounds like a lot. How does the VA check for all this? This is where a critical player enters the scene, the VA certified appraiser. And this is also where one of the biggest points of confusion comes in. A VA appraisal is not a home inspection. I need you to hear me on this. Say it with me. A VA appraisal is not a home inspection. The VA appraiser has two primary jobs. Job 1 is to determine the fair market value of the property. They look at comparable home sales in the area to make sure you and the lender aren't overpaying for the house. Job 2 is to perform a high-level check to see if the property meets those minimum property requirements we just talked about, the safe, sound, and sanitary stuff. They are looking for obvious, visible defects. They are the gatekeepers for the VA. A home inspector, on the other hand, works for you. You hire them, you pay them, and their loyalty is to you and you alone. They conduct a deep dive, top-to-bottom forensic investigation of the house. They'll climb on the roof, crawl through the attic and crawl space, test every outlet, run every appliance, check the age and condition of the furnace and water heater, and look for hundreds of potential issues, big and small. Their report will be dozens of pages long with photos and detailed explanations of everything from a leaky faucet to a potential foundation problem the appraiser might have missed. Let me put it this way. Imagine you find what you think is your dream home. It's an older house with tons of character. The VA appraiser walks through. They see that the character-filled peeling paint in the bedroom is a lead-based paint hazard. They notice the rustic roof has some missing shingles and signs of a leak in the attic. They tap on the charming wooden porch post and realize it's been hollowed out by termites. Based on these NPR failures, the appraisal comes back subject to repairs. But what the appraiser doesn't do is check the 25-year-old furnace that's on its last legs, or the electrical panel that's dangerously outdated, or the slow drain in the shower that indicates a clog deep in the pipes. The house could pass the VA appraisal after the seller fixes the paint, roof, and porch, but you could still be on the hook for $10,000 in other necessary repairs that only a home inspector would have found. So please, I am begging you, always get a separate home inspection. It is the best few $100s you will ever spend. It gives you the full picture and the ultimate power to negotiate or walk away. Okay, so what happens in that scenario? The VA appraiser flags the required repairs. The dream home has failed. Is the deal dead? Absolutely not. This is a normal part of the process and you have options. When the appraisal is complete, the VA issues what's called a Notice of Value, or NOV. This document will state the appraised value of the home, and will list any and all repairs that must be completed before the loan can close. Once you have that list, the negotiations begin. Your first and best option is to have the seller pay for the repairs. In most markets, this is the standard expectation. You, through your real estate agent, present the list from the NOV to the seller and say, for this deal to move forward, these items need to be fixed by a licensed professional, and will need proof of completion for the appraiser. The seller, who wants to sell their house, will usually agree. They'll hire the contractors, get the work done, and the appraiser will come back out for a final inspection to sign off on it. Option 2, you, the buyer, can pay for the repairs. This is much less common and you have to be careful. Some lenders may not even allow it. But if the repairs are minor and you're getting an incredible deal on the house, you might offer to handle them just to keep the deal moving smoothly. Option 3 is to meet in the middle. Maybe the seller agrees to fix the roof and the porch, but asks you to cover the cost of the interior painting. Everything in real estate is negotiable. But what if the repairs are major? What if the seller is unwilling or unable to pay for a new $20,000 roof? This is where another powerful underutilized tool comes into play. The VA renovation loan. This loan allows you to roll the cost of the repairs and upgrades into your mortgage. So you can buy that fixer-upper, finance the new roof, and have the work done after you close. It's a fantastic option that lets you consider homes other buyers might have to pass on. And finally, there's your ultimate protection. The right to walk away. The VA loan comes with an escape clause. If the house doesn't appraise for the contract price, or if you and the seller can't come to an agreement on the required repairs, you can cancel the contract and in almost all cases, get your earnest money deposit back. The NPRs and the appraisal process give you a safe exit if the property just isn't right. They protect you from making a catastrophic financial mistake. So the minimum property requirements aren't a monster hiding in the closet. They are your guardian angel. They ensure your new home is a blessing, not a curse. The appraisal is the tool that enforces those requirements, and the home inspection is your personal magnifying glass to see the whole truth. Understanding this process, knowing your options, and leaning on your real estate agent's expertise transforms it from a stressful hurdle into a powerful negotiation tool. So the house passed the appraisal, the seller made the repairs, and you're ready to move forward. But there's still one giant piece of the puzzle: your personal finances. We're talking about credit scores, debt-to-income ratios, and the myth of the perfect VA loan applicant. How low can your credit score really be? And what's the one number that lenders care about more than anything else? That's what we're diving into next. Alright, let's break down the numbers that truly matter. First up, the big one, your credit score. If you've been on any forum or talked to any loan officer, you've probably heard a dozen different answers. So what's the truth? The official VA handbook, the document that governs this entire program, states that there is no minimum credit score requirement. Let me say that again. The Department of Veterans Affairs does not set a minimum credit score for you to be eligible for a VA loan. Technically, you could have a 500 credit score and the VA itself wouldn't automatically disqualify you. This is a fact, and it's one of the most misunderstood aspects of the entire process. So why is everyone, from your local bank to your brother-in-law, obsessed with a 620 or 640 score? The answer lies in the difference between the VA and the lender. Remember, the VA doesn't actually give you the money. They just guarantee a portion of the loan for a private lender like a bank or a credit union. This guarantee reduces the lender's risk, but it doesn't eliminate it. So the lenders create their own internal rules, which we call overlays. An overlay is simply a requirement that is stricter than what the VA asks for. And the most common overlay in the entire mortgage industry is a minimum credit score. Lenders are in the business of managing risk. They've run the numbers on millions of loans, and their data tells them that borrowers with scores below a certain threshold are statistically more likely to default. So, to protect themselves, they draw a line in the sand. For many lenders, that line is a 620 or 640 FICO score. But here's the crucial part. Not all lenders are the same. This isn't a universal rule. Some lenders who specialize in VA loans are more comfortable with the program's flexibility and might set their minimum score at 600 or even 580. It's a competitive advantage for them. They're willing to look at the whole picture of an applicant, not just a single 3-digit number. This means one of the most important things you can do is shop for the right lender, not just the right house. If one lender tells you no because your score is 610, don't give up. The next lender might say yes. Your mission is to find a lender who has experience with VA loans and is willing to do what's called a manual underwrite, where a human being actually looks at your entire financial story instead of letting a computer algorithm make the decision. So while the VA sets no minimum, the reality is you'll likely need a score of at least 580 to 620 to get your foot in the door with most lenders. Anything above 640 opens up even more options. But here's the secret. The credit score is just the gatekeeper. It gets you past the front desk. The number that the underwriter, the person who actually approves or denies your loan, cares about far more is your debt-to-income ratio, or DTI. This is the number I hinted at before. DTI is the heart of your financial qualification. It's a simple percentage that tells the lender how much of your monthly income is already spoken for by debt. It's a snapshot of your financial obligations versus your earnings. Here's how you calculate it. First, you add up all of your monthly debt payments. We're talking about the minimum payments on your credit cards, your car loan, any student loans, personal loans, and child support or alimony payments. Notice what's not on that list. Things like your cell phone bill, car insurance, or grocery budget. We're only talking about debt obligations that show up on your credit report, plus things like alimony. Let's say your car payment is $400, your student loan payment is $200, and the minimum payments on your credit cards add up to $150. Your total monthly debt is $750. Next, you need your gross monthly income. That's your income before any taxes or deductions are taken out. If you earn a salary of $60,000 a year, your gross monthly income is $5,000. Now you just do the math. Divide your total monthly debt by your gross monthly income. So $750 divided by $5,000 equals 0.15. As a percentage, that's a 15% DTI. The VA has a general guideline here. They prefer to see a DTI of 41% or less. This 41% includes your new estimated mortgage payment, principal, interest, taxes, and insurance. So if your current DTI is 15% and your new mortgage is going to be $1,500 a month, your new total monthly obligation is $2,250. Divide that by your $5,000 income, and your new DTI is 45%. Now, you might be thinking, wait, 45% is higher than the 41% guideline. Am I disqualified? And the answer is a resounding no, because the VA has a secret weapon, a trump card that overrides the DTI guideline. It's the real number one metric they use to determine if you can truly afford the home. It's called residual income. Residual income is the amount of money you have left over each month after you've paid all your major obligations, including your new mortgage, taxes, debt payments, and estimated utilities. It's your discretionary income, the money for gas, food, clothing, and everything else life throws at you. Why is this so important? Because the VA's primary goal is to promote sustainable homeownership for veterans. They don't want to put you in a house you can't afford to live in. A foreclosure is devastating for a family, and it's a loss for the VA. Residual income is their number one tool for preventing that. It's a real-world common sense check. It answers the question, after all the big bills are paid, does this veteran have enough cash left to actually live a reasonable life? The amount of residual income you need depends on your family size and where you live in the country. The VA has a chart that breaks it down. For example, a single veteran in the Northeast might need around $491 left over each month. A family of 4 in the Midwest might need about $990. A family of 5 in California will need an even higher amount, over $1,100. It's logical. A bigger family in a more expensive area needs more money for daily life. This is where the magic happens. An underwriter can approve a loan with a DTI of 50%, 55%, or even higher, as long as you meet the residual income requirement for your family and region, and you have what are called compensating factors. Compensating factors are positive elements in your financial profile that help offset the risk of a high DTI. They tell the underwriter, hey, I know this number looks high, but here's why I'm still a safe bet. What are they? Excellent credit is the big one. If you have a 740 credit score, they know you have a long history of paying your bills on time. Significant cash reserves are another huge factor. If you have 6 months worth of mortgage payments sitting in a savings account after you close, it shows you can handle an unexpected job loss or emergency. A long, stable job history in the same line of work also helps. Or maybe you've been paying $2,000 a month in rent for the last 5 years without a single late payment, and your new mortgage is only $1,800. That's a powerful compensating factor. Let me paint a picture. Imagine 2 veterans. Veteran A has a 680 credit score and a 40% DTI, right under the guideline. But he has very little savings and his residual income is just barely over the minimum required. Veteran B has a 630 credit score and a 52% DTI, which looks risky on the surface. But she has $20,000 in the bank, has been at the same job for 10 years, and her residual income is 30% higher than the requirement. Who is the stronger applicant? In the eyes of a VA underwriter, it's Veteran B, almost every single time. The high DTI is offset by her massive compensating factors. She has demonstrated stability and a financial cushion. So don't obsess over the credit score. Don't panic if your DTI is over 41%. Focus on the whole picture. Build up your savings. Maintain a stable job. And most importantly, understand that your ability to have enough money left over at the end of the month, your residual income, is the ultimate key to unlocking your VA home loan benefit. Now that we've covered your financial fitness, your credit, your debt, and your income, it's time to talk about the actual money involved in the transaction. The VA loan is famous for requiring no down payment, but does that mean it's a completely free ride? What about closing costs? What is the VA funding fee and will you have to pay it? We're about to break down every single dollar you might, or might not need to bring to the table, and reveal how it's possible to get the keys to your new home without writing a single check. Alright, let's talk about money, because at the end of the day, that's what it all comes down to. You've served your country, you've earned this benefit, but you still need to know, what is this actually going to cost me? The number one question we get, the single biggest myth about buying a home, revolves around the down payment. For decades, we've been told you need 20% down. 20%. On a $400,000 home, that's $80,000 in cash. For most people, that's not just a barrier, it's a brick wall. Then came other loan types like FHA that lowered it to 3.5%. Better, but that's still $14,000 on that same home. This is where the VA home loan truly separates itself from every other mortgage on the planet. For a VA loan, the minimum required down payment is zero. Not a typo. $0. You can finance 100% of the home's purchase price. This is, without a doubt, the most powerful feature of the VA loan program. It's the feature that has single-handedly enabled millions of veterans and service members to become homeowners when they otherwise couldn't have. It removes that giant brick wall and replaces it with an open door. Now, just because you can put zero down doesn't always mean you have to. You absolutely have the option to make a down payment if you want to. Why would you? Few reasons. First, it gives you instant equity in your home. Second, it lowers your monthly mortgage payment. And third, as we're about to see, it can reduce the cost of a very specific VA-related fee. But the key takeaway is that the choice is yours. The VA does not require it. So if you're looking at your bank account and thinking homeownership is a decade away, I'm here to tell you it might be a lot closer than you think. But a $0 down payment sounds too good to be true, right? There has to be a catch. And there is, sort of. It's called the VA funding fee. This is probably the most misunderstood part of the entire VA loan process. So let's clear it up right now. The VA funding fee is a one-time fee paid to the Department of Veterans Affairs. It's not a fee the lender keeps. This money goes directly to the VA to help cover losses from the few loans that go into default. Think of it like an insurance premium that keeps the entire program running for future generations of veterans, ensuring the VA can continue to guarantee these loans with no down payment and no monthly mortgage insurance. So how much is it? This is where it gets a little detailed, but stick with me because this one detail could save you thousands. The fee is a percentage of your loan amount, and that percentage depends on three things: your service type, whether it's your first time using the benefit, and the size of your down payment. For most veterans, active duty members, and National Guard or Reserve members using the benefit for the very first time with zero down payment, the funding fee is 2.15%. So on a $400,000 loan, that's $8,600. If you decide to put 5% down, the fee drops to 1.5%. Put 10% down or more, and it drops even further to 1.25%. Now, what if this isn't your first rodeo? If you've used your VA loan benefit before, this is called a subsequent use. For subsequent use with zero down, the fee is higher, typically 3.3%. This is because the VA is taking on a bit more risk. Again, making a down payment of 5 or 10% will lower that fee significantly. I know what you're thinking. $8,600? $3,300? That's a lot of money. And you're right. But here's the critical part. You almost never pay this out of pocket. In the vast majority of cases, the VA funding fee is simply rolled into your total loan amount and paid off over the life of the mortgage. So on that $400,000 loan, your new loan amount would be $486,600. Your monthly payment will be slightly higher, but you didn't have to write a check for it at closing. But it gets even better. What if you could pay nothing at all? There is a massive exception to the VA funding fee, and you need to know if you qualify. Certain veterans are completely exempt from paying this fee. This is not a discount, it's a full waiver. You are exempt if you are a veteran receiving VA compensation for a service-connected disability. You are also exempt if you are a veteran who is entitled to receive disability compensation, but you're receiving retirement or active duty pay instead. Active duty service members who have been awarded the Purple Heart are also exempt. And very importantly, this exemption extends to surviving spouses of veterans who died in service or from a service-connected disability. If you fall into any of these categories, you pay zero. Your funding fee is waived. That's a savings of thousands, sometimes tens of thousands of dollars right off the top. This is the VA's way of recognizing the immense sacrifice of our nation's disabled veterans and their families. So let's recap the money so far. We have a $0 down payment requirement, and we have a VA funding fee that can either be rolled into the loan or, for many veterans, waived entirely. This is how the no money down promise starts to become a reality. But there's one more piece to this puzzle. The part that trips a lot of people up: closing costs. This is the big gotcha for many first-time homebuyers. They hear no down payment and think it means no cash to close. That is not the same thing. Every real estate transaction, whether it's a VA loan or not, has closing costs. These are the fees for the services required to actually close the loan and transfer the property title to you. What are they? Things like the appraisal fee, which is required by the VA to ensure the home is worth what you're paying for it. The credit report fee. Title insurance, which protects you and the lender from any future claims on the property. Recording fees paid to the county to officially record you as the new owner. There can also be loan origination fees, survey fees, and other administrative costs. On average, you can expect closing costs to be somewhere between 2 to 5% of the purchase price. On our $400,000 home, that could be anywhere from $8,000 to $20,000. So who pays for this? This is where you, as a VA borrower, have a secret weapon in your toolkit. It's called seller concessions. The VA allows the seller of the home to pay for some, or even all of your closing costs on your behalf. The VA rule is incredibly generous. The seller can contribute up to 4% of the home's value towards your closing costs. This can include things like your appraisal, your title fees, and even prepaying your property taxes and homeowner's insurance for the year. On that $400,000 home, 4% is $16,000. That is a massive amount of money that a seller can contribute to make the deal happen. This is not a gift. It's a negotiation. When you make an offer on a home, your real estate agent can write into the contract that you're asking the seller to pay, for example, $10,000 of your closing costs. In a competitive market, this might be a tough negotiation, but in a more balanced market, it's very common. Sellers want to sell their home, and contributing to a qualified veteran's closing costs is often a fantastic way to get the deal done. So now let's connect all the dots. Let's see how it's possible to walk into your new home without writing a single check at closing. Let's imagine a veteran. We'll call her Sarah. Sarah is buying a $400,000 home. She has a VA disability rating, which means she is exempt from the VA funding fee. She uses her VA loan benefit to put $0 down. Her closing costs come out to $12,000. In her purchase offer, her agent negotiates for the seller to pay all $12,000 in seller concessions. The seller agrees. Let's do the math. Down payment $0. VA funding fee $0 because she's exempt. Closing costs $12,000 but paid for entirely by the seller. The total amount of cash Sarah needs to bring to the closing table is $0. She gets the keys to her new home, a home she earned through her service, without spending a single dollar out of her own pocket that day. This isn't a fantasy. This happens every single day across the country, thanks to the power of the VA home loan. Now, your situation might be different. You might have to pay the funding fee. You might only be able to negotiate for the seller to pay half of your closing costs. But understanding these moving parts, the down payment, the funding fee, and the closing costs, is the key. It's what allows you to build a strategy. It's what turns the dream of homeownership into a concrete, achievable plan. But this financial picture is only one side of the coin. The other side is you, your personal financial health. The VA needs to know you can afford the home long term. And that brings us to the critical topic of credit. What credit score do you actually need for a VA loan? The answer is going to surprise you. The truth is, the Department of Veterans Affairs has no minimum credit score requirement. 0. It's not written anywhere in their official handbook. This is one of the biggest myths in the entire mortgage world. The VA's official stance is that a veteran's past credit history is not a barrier to getting a loan. They look at the overall picture. So if the VA doesn't require a minimum score, why does everyone talk about it? Why did your buddy get turned down for having a 590? The answer lies in understanding who is actually giving you the money. The VA isn't a bank. They don't have a giant vault of cash they're handing out for home loans. They are the insurer of the loan. They provide a guarantee to a private lender, a bank, a credit union, a mortgage company, that if you, the veteran, default on your loan, the VA will cover a portion of the lender's loss. This guarantee is what makes the VA loan so powerful and allows lenders to offer such incredible terms, like 0 down payment. But because a private company is the one actually lending you hundreds of thousands of dollars, they get to set their own internal rules. These are called lender overlays. Think of it like this. The VA sets the absolute minimum safety standards for a car. It has to have seatbelts, airbags, and brakes that work. But Ford might decide their cars will also have lane keep assist and blind spot monitoring as standard features. They've added their own rules, their overlays, on top of the government's minimum requirements to make their products safer and reduce their own risk. Lenders do the exact same thing with VA loans. The VA says, no minimum credit score. But a lender might say, that's great, but for us to feel comfortable lending $500,000, we need to see a minimum score of 620. They are adding an overlay, and they have every right to do so. They're the ones with the money on the line. So what is the real credit score you need? In the real world, most lenders will want to see a FICO score of at least 620. This has become a sort of unofficial industry standard. It's the benchmark where most automated underwriting systems start giving the green light. Can you get a VA loan with a score below 620? Absolutely. There are fantastic lenders who specialize in VA loans who will go down to 600, or even 580 in some cases. But the lower you go, the more scrutiny every other part of your file will receive. They'll want to see a very stable job history, more income, or fewer monthly debts to compensate for the perceived risk of a lower credit score. This is why shopping for a lender is not just about the interest rate. It's about finding a lender whose guidelines fit your profile. But obsessing over the exact number, is it 620? Is it 580? Misses the entire point. The number itself is just a symptom. It's a grade on a report card. What lenders really care about is what's on the report card itself. They want to understand the story your credit history tells about you. Your credit score is a 3-digit summary of your financial habits, and it's primarily built on 5 key factors. Understanding these is the key to not just getting approved, but to mastering your financial life. The first and by far the most important is your payment history. This accounts for a massive 35% of your FICO score. Think of your credit report as your financial resume. Your payment history is the entire work experience section. It answers one simple question. Do you pay your bills on time? Every single late payment, whether it's 30, 60, or 90 days late, is a negative mark. It's like showing up late to work. Do it once and your boss might give you a warning. Do it consistently and you're seen as unreliable. Lenders see it the same way. A long history of on-time payments tells them you are responsible and trustworthy. This is the bedrock of a great credit score. The second most important factor is amounts owed, or what's often called your credit utilization ratio. This makes up another 30% of your score. This is where so many people get tripped up. It's not about how much debt you have in total. It's about how much of your available credit you are using. Let's say you have one credit card with a $10,000 limit. If you have a $9,000 balance on it, you are using 90% of your available credit. To a lender, this is a giant red flag. It signals that you are financially stretched to the limit, living paycheck to paycheck with no breathing room. It looks like you're one unexpected car repair away from disaster. Now, imagine that same person has a $1,000 balance on that $10,000 card. Their utilization is only 10%. This paints a completely different picture. It tells a story of control, of discipline, of someone who uses credit as a tool, not a crutch. Keeping your credit utilization below 30% across all your cards is one of the fastest ways to boost your credit score. The next factor, worth about 15%, is the length of your credit history. This is about your track record. Lenders like to see a long history of responsible credit management. An account that's been open and in good standing for 10 years is more valuable than one that's been open for 10 months. To show stability, this is why the common advice to close old credit cards you don't use is often terrible advice. Closing your oldest account can shorten your credit history and actually lower your score. Then you have credit mix, which is about 10% of your score. Lenders like to see that you can successfully manage different types of credit. For example, a mix of revolving credit, like credit cards, and installment loans like a car loan or a student loan, shows you're a well-rounded borrower. It's not a deal breaker, but it helps. Finally, the last 10% is new credit. This looks at how recently you've been applying for credit. If you apply for 5 different credit cards and 2 personal loans in the span of a month, it sends a signal of desperation. It looks like you're in a financial bind and are scrambling for cash. Each of these applications results in a hard inquiry on your report, which can temporarily ding your score a few points. It's perfectly fine to have a few inquiries when you're shopping for a major purchase like a car or a mortgage, but a sudden flurry of activity is a warning sign. So, what if your credit story has some blemishes? What if you have collections or even a bankruptcy? This is where the VA loan truly shines. The VA guidelines are incredibly forgiving. If you have collections or charged-off accounts, the VA doesn't necessarily require you to pay them off. The lender will look at the big picture. Was it a medical collection from an unexpected hospital stay 3 years ago? Or was it a credit card you maxed out on a vacation and then just stopped paying 6 months ago? They'll look at the size, the age, and the reason for the collection. The key is to be upfront about it and have a good explanation. What about the big one, bankruptcy? For many, this feels like a financial death sentence. With a VA loan, it's not. For a Chapter 7 bankruptcy, which is a total liquidation of your debts, You generally only need to wait 2 years from the date of discharge. During those 2 years, you need to show you have lived responsibly and re-established good credit. You paid your rent on time, you managed a new secured credit card perfectly. You're proving that the bankruptcy was a reset, not a reflection of your permanent character. For a Chapter 13 bankruptcy, where you're on a repayment plan, the rules are even more incredible. It's often possible to qualify for a VA loan after you've made just 12 months of on-time payments within your bankruptcy plan. As long as you get approval from the bankruptcy court trustee, you can literally buy a home while you are still in bankruptcy. That's how much the VA program believes in giving veterans a second chance. So, the first step is not to guess. It's to know. You need to pull your credit report. You are legally entitled to a free copy from all 3 major bureaus, Equifax, Experian, and TransUnion, once a year. Go to annualcreditreport.com. That is the official government-mandated site. Don't get fooled by imitators. Once you have your reports, read through every single line. Look for errors. A misspelled name, an account that isn't yours, a late payment that was actually on time. These mistakes are more common than you think, and they can be devastating to your score. If you find an error, dispute it immediately with the credit bureau. Then focus on the 2 things that matter most. Pay every single bill on time, from this day forward. Set up autopay. Do whatever it takes. And second, attack your high-balance credit cards. Pay them down aggressively to get that utilization ratio down. These 2 actions alone can create dramatic improvements in your score in just a few months. The most important thing you can do is talk to a VA loan specialist early in the process. Don't wait until you think your credit is perfect. A great loan officer acts as a coach. They can run your credit, look at your specific situation, and give you a concrete, personalized action plan. They might say, okay, if you pay this one credit card down by $500, our credit simulator shows your score will jump 30 points, and that will be enough to get you pre-approved. They can guide you from where you are to where you need to be. Your credit score doesn't define you. It's a snapshot in time of a story that you are still writing. And with the VA loan, you have a program that's designed to read beyond the headline and give you the chance to write the next chapter. Now that you understand the story your credit tells, we need to look at the other side of the financial ledger. Your income. How much money do you actually need to make to afford a home? How does the VA verify it? And what is the single most important calculation that determines your borrowing power? The debt-to-income ratio. That's where we're going next, and it's the key that unlocks how much house you can truly buy. So let's break down that key, the debt-to-income ratio, or DTI. It sounds technical, but the concept is incredibly simple. It's a percentage that shows how much of your monthly gross income, that's your income before any taxes are taken out, goes towards paying your monthly debts. Lenders use it to gauge your ability to manage monthly payments and repay a mortgage. Imagine your income is a pie. DTI is the slice of that pie you've already promised to other people, your car loan, your student loans, your credit cards. The lender wants to see how much pie is left for them, and more importantly, for you to live on. The formula is straightforward. You take your total monthly debt payments, divide that by your gross monthly income, and you get your DTI. Let's walk through it. Say you're a service member earning a gross income of $6,000 a month. Now let's add up your debts. You have a car payment of $400, a student loan payment of $300, and the minimum payments on your credit cards total $200. Your total monthly debt is $900. So you take $900, divide it by $6,000, and you get 0.15 or a 15% DTI. That's your DTI before adding a mortgage. Now here's the number you've probably heard whispered in forums or by loan officers: 41%. The VA has a guideline, and I want you to burn that word into your brain, guideline, that it prefers a borrower's total DTI, including the new mortgage payment, to be at or below 41%. So in our example, if your new mortgage payment, including principal, interest, taxes, and insurance, is $1,300 a month, your total debt would be $900 plus $1,300, which is $2,200. $2,200 divided by your $6,000 income is about 37%. You're under the 41% guideline. You're in great shape. But what if you're not? What if your new mortgage pushes your DTI to 45 or 48 or even 50%? With almost any other loan type, that's a dead end. An automated system flags it, and you get a rejection letter. End of story. But this right here is where the VA loan proves it was built differently. It's where the human element comes in. Because the VA knows that a single percentage point doesn't tell the whole story of your financial life. This is why they have a second, even more important financial requirement that works in tandem with DTI. It's the VA's secret weapon for qualifying more veterans: residual income. If DTI is about the percentage of your income that's spoken for, residual income is about the actual hard dollar amount you have left over to live on. It is the money remaining each month after you've paid all your major obligations. Your new mortgage payment, your other debts, estimated utilities for the new house, federal and state taxes, and childcare expenses. This is the money for food, for gas in the car, for clothes, for unexpected repairs, for living. The VA doesn't just want to know if you can pay the mortgage. It asks a much more profound and protective question. After you pay everyone else, will you have enough money to comfortably run your household and take care of your family without financial distress? This isn't just a random calculation. The VA has specific residual income guidelines that you must meet. They've done the research. They've broken the country down into 4 regions: Northeast, Midwest, South, and West. And they've set different minimums based on the cost of living in each area. And it gets even more specific because the requirement also changes based on the size of your family. It makes perfect sense. A family of 5 living in San Diego needs more cash left over each month than a single person living in rural Alabama. For example, a family of 4 in the South might need to show they have about $1,039 left over each month. That same family in the Northeast would need $1,158. These numbers are updated periodically, but the principle remains the same. The VA sets a common-sense baseline for monthly living expenses. So how do these two powerful metrics, DTI and residual income, work together? This is the magic. Let's go back to our borrower whose new mortgage pushed their DTI to 48%. A conventional loan application is already in the trash can, but the VA underwriter keeps going. They calculate the residual income. They take the $6,000 gross income, subtract all the taxes, the debts, the new housing payment, the estimated utilities, and they find that this family has $1,600 left over at the end of the month. Now, the underwriter looks at the VA's regional table. For this family of 4 in the Midwest, the minimum required residual income is, let's say, $1,003. Our borrower has $1,600. They aren't just meeting the guideline. They are exceeding it by nearly $600. This is what's known as a compensating factor. The underwriter can see with crystal clarity that even though this veteran's debt-to-income ratio is high, their actual monthly cash flow is incredibly strong. They have more than enough money to live comfortably and handle unexpected expenses. And on that basis, the loan is approved. This is happening every single day. Strong residual income is the #1 reason veterans get approved for a VA loan, even with a DTI well above that 41% guideline. It's a system built on financial reality, not just rigid percentages. Of course, to calculate these numbers, you need to know what the VA actually counts as income and debt. For income, the keywords are stable, reliable, and likely to continue. This obviously includes your base pay if you're active duty, but it also includes your basic allowance for housing, BAH, and basic allowance for subsistence, BAS. For veterans, it's your retirement pay, VA disability compensation, which is tax-free and can often be grossed up by lenders to give you more buying power, and of course, income from your civilian job. If you have a spouse on the loan, their income counts too. The key is usually a 2-year history for things like part-time work or self-employment, but the goal is always to paint a picture of dependable income. On the flip side, what counts as debt for your DTI? It's your recurring contractual obligations. Think car loans, student loans, personal loans, and the minimum monthly payments on credit cards and lines of credit. It also includes any court-ordered payments like alimony or child support. What it does not include are your day-to-day living expenses. Your cell phone bill, your car insurance, your electricity bill, your grocery budget, those are not counted in your DTI ratio. Why? Because those are the very things that residual income is designed to cover. DTI handles the fixed debts. Residual income ensures you can handle the variable costs of life. This two-pronged approach is a financial safety net woven directly into the fabric of the VA loan program. It provides a level of flexibility and common-sense underwriting that you simply will not find anywhere else. It allows a human underwriter to look beyond the numbers on a screen and see the real financial health of a veteran and their family. It's a system designed not just to get you a key, but to make sure you can keep the home that key unlocks for years to come. We've now covered the foundation of your financial picture, your income and your debts. But there's another critical piece of your financial story that lenders will scrutinize: your past. How have you handled credit and debt before? This brings us to the most misunderstood topic in the entire VA loan process: the credit score. Does the VA even have a minimum score requirement? What are lenders really looking for when they pull your credit report? And what red flags can stop an otherwise perfect application in its tracks? Unlocking those secrets is the next crucial step on your path to homeownership. So let's start with the biggest secret, or rather the biggest myth in the entire VA loan world: the idea that there is no minimum credit score. Technically, this is true. The Department of Veterans Affairs itself, the government entity that guarantees your loan, does not set a minimum FICO score. They don't look at your application and say, "Sorry, a 570 isn't good enough." Their focus is on the big picture of your financial stability and your entitlement. But here's the reality check, and it's the single most important thing you need to understand about credit and VA loans. You are not getting your loan from the VA. You are getting it from a private lender, a bank, a credit union, a mortgage company, and the VA simply insures a portion of it. This insurance is what makes the lender feel safe enough to give you incredible terms like zero down payment. And because these private lenders are the ones putting up the hundreds of thousands of dollars, they have their own rules. These are called lender overlays. Think of it like this: the VA sets the baseline, the absolute minimum federal requirements. But a lender can, and almost always does, add their own stricter requirements on top. It's their money, so it's their right. And the most common overlay of all is a minimum credit score. So what is that magic number? While it varies from lender to lender and can change with the economy, the unofficial industry standard generally starts around a 620 FICO score. Some lenders might be a little more flexible, maybe dipping down to 600 or even 580 in certain cases, but 620 is the benchmark you should really aim for. Many of the more competitive lenders, the ones offering the best rates and service, will often look for a 640 or higher. Why? Because a credit score, for all its flaws, is the lender's quickest snapshot of your financial reliability. It's a risk assessment tool. A score below 620 signals to them that there might be some recent financial struggles, and their internal risk models just won't approve the loan. A score above 640, on the other hand, tells them you have a solid history of managing your debts, which makes you a much more attractive borrower. But here's the secret lenders won't always tell you up front: the score is just the headline. It gets them to open the book, but they are going to read every single chapter of your credit report. A 750 score with a recent foreclosure is far worse than a 640 score with a perfect payment history for the last 3 years. The story behind the score is what truly matters. So let's pull back the curtain and look at your credit report through the eyes of a VA loan underwriter. What are they really looking for? First and foremost, they are laser-focused on your payment history over the last 12 to 24 months. This is the king of all credit factors. They understand that life happens. Maybe you had a medical issue, a job loss, or a divorce 5 years ago that wrecked your credit. While that's not ideal, it's understandable. But what have you done since then? Your recent history is a testament to your current financial habits. An underwriter wants to see a clean slate for at least the last year. That means 0 late payments on any of your accounts, number 30-day lates on your car loan, your student loans, or any of your credit cards. A single recent late payment is a massive red flag. It tells them that despite wanting to buy a home, you are still struggling to manage your current obligations. If you can't make a $300 car payment on time, how can they trust you with a $2,000 mortgage payment? If you have any late payments, be prepared to write a detailed letter of explanation, but know that recent ones can be a deal killer. Next, they scrutinize any derogatory accounts. These are things like collections, charge-offs, and judgments. A few old medical collections for small amounts might be overlooked, especially if you can show they've been paid or settled. But a recent collection from a cell phone provider or a utility company, that's another red flag. Again, it speaks to your current financial management. The VA guidelines are actually quite flexible here, but the lender's overlays might require you to pay off all collections before closing. A good rule of thumb: if you have non-medical collections totaling more than a couple $1,000s, expect the lender to address it. Then there are the major derogatory events: bankruptcy and foreclosure. Yes, you can absolutely get a VA loan after one of these, but you have to respect the waiting periods. For a Chapter 7 bankruptcy, you generally need to wait 2 years from the date of discharge. The key here is what you did in those 2 years. The underwriter needs to see that you have re-established credit responsibly. You got a secured credit card, you made every payment on time, You prove that the bankruptcy was a fresh start, not a repeating pattern. For a Chapter 13 bankruptcy, you can sometimes qualify while you're still in the repayment plan, typically after you've made at least 12 months of on-time payments. But you'll need permission from the bankruptcy court, which adds another layer to the process. If you had a foreclosure, the waiting period is also typically 2 years from when the foreclosure was finalized. And here's a crucial detail. If that foreclosure was on a previous VA loan, the waiting period is still 2 years, but you'll also need to have fully repaid the VA for any loss they incurred before you can get your full entitlement back. Beyond your payment history, the second thing an underwriter obsesses over is your level of debt, specifically your credit utilization. This is the percentage of your available credit that you're currently using. For example, if you have one credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. High utilization is a silent killer of mortgage applications. Even if you've never missed a payment, having all your credit cards maxed out screams financial distress. It tells the lender you are living on the edge, relying on credit to get by month to month. The general rule is to keep your utilization on each card, and overall below 30%. Getting below that threshold can dramatically improve your credit score, and more importantly, it shows the underwriter that you have financial breathing room. You aren't one broken appliance away from a crisis. So let's put it all together. The lender isn't just looking for a number. They are trying to build a profile of you as a borrower. They are asking, does this person have a demonstrated history of paying their bills on time, especially recently? Are they currently overextended and reliant on debt? Have they recovered from past financial hardships and learned from them? Your credit report is your financial resume, and you need to make sure it tells the right story. Before you even talk to a lender, you need to become the expert on your own credit. Go to annualcreditreport.com, that's the official, government-mandated site, and pull your reports from all 3 bureaus, Equifax, Experian, and TransUnion. It's completely free once a year. Go through every single line item. Is that late payment from 2 years ago accurate? Or were you in a forbearance program? Is that collection account even yours? You would be shocked at how many errors are on credit reports. Dispute every single inaccuracy, both with the credit bureau and the original creditor. If the report is accurate but not perfect, it's time to create a plan. If your credit utilization is high, focus on aggressively paying down those balances. Start with the card that has the highest utilization percentage, not necessarily the highest interest rate. If you have late payments, start a new track record of perfection. Every on-time payment you make from this day forward helps to bury the mistakes of the past. Remember, a lender denying you today isn't a final judgment. It's a snapshot in time. A good loan officer won't just say no. They will look at your credit and say, not yet. But if you do X, Y, and Z and we talk again in 6 months, you'll be in a great position. They will give you the roadmap. Your credit isn't a fixed state. It's a dynamic score that you have the power to change. Building or repairing credit is a marathon, not a sprint. It takes discipline and time. But understanding what lenders are truly looking for, that pristine 12-month history, that low credit utilization, and a clean slate from major derogatory events is the key. It moves you from being a passive applicant hoping for the best to an active participant, shaping your financial story to ensure the answer you get is approved. Now, assuming your credit is in order, there's another critical number that can make or break your VA loan approval, and it has nothing to do with your credit score. It's a simple ratio that measures your income against your debts, and it determines just how much house the lender believes you can truly afford. This crucial number is your debt-to-income ratio, or DTI. And while it sounds like complicated financial jargon, it's actually a very simple snapshot of your financial health. Think of it as a stress test for your wallet. Lenders use it to see how much of your monthly income is already spoken for, before you even think about adding a mortgage payment. The calculation itself is straightforward. You take all your monthly debt payments, add them up, and then divide that total by your gross monthly income. That's your income before taxes. The result, expressed as a percentage, is your DTI. So what counts as debt? We're talking about the minimum required payments on things like car loans, student loans, credit card bills, personal loans, and any alimony or child support you're required to pay. Notice I said minimum required payments. Even if you pay $1,000 on your credit card every month, but the minimum payment is only $50, the lender only counts that $50. What doesn't count? Things like your monthly grocery bill, gas for your car, utilities, or your cell phone bill. These are living expenses, not fixed debts, so they aren't part of the DTI calculation. Let's run a quick example. Let's say you're an E6 with 10 years of service, and your gross monthly income is around $5,000. Now let's add up your debts. You have a car payment of $400 a month. You have a student loan payment of $150. And the minimum payments on your credit cards total $100. So you added up 400 plus 150 plus 100. Your total monthly debt is $650. Now we take that $650 and divide it by your $5,000 gross monthly income. The result is 0.13, or a DTI of 13%. That 13% represents the portion of your income that's already committed to other lenders. But we've forgotten the most important piece of the puzzle: the new mortgage payment. Let's imagine the house you want to buy will have a total monthly payment, including principal, interest, taxes, and insurance, of $2,000. We have to add that to your existing debts. So now your total proposed monthly debt is $2,650. We divide that by your $5,000 income. The result? A DTI of 53%. Now, you might be looking at that 53% and starting to sweat. And in the world of conventional loans, a DTI that high would be a massive red flag, likely leading to an instant denial. This is where the VA loan program changes the game completely. The VA has a guideline, and I want you to burn that word into your memory: guideline, that they prefer to see a borrower's DTI at or below 41%. For decades, this 41% number has been treated like a sacred law by borrowers, and even some inexperienced lenders. People see it online, assume it's a hard and fast rule, and if their own calculation comes out to 42%, they give up before they even start. They believe the dream is over. But that is absolutely not the case. The 41% DTI is not a stop sign. It's a yield sign. It's a signal for the underwriter to slow down, look a little closer, and make sure you can truly handle the financial responsibility of the loan. And how do they do that? This brings us to the VA's secret weapon, the single most important factor in determining your true borrowing power, and it's something most other loan types completely ignore. It's called residual income. If DTI is a snapshot of your obligations, residual income is a forecast of your actual, day-to-day living money. It's the amount of cash you have left over each month after paying for everything. And I mean everything: your new mortgage, your car payment, your credit cards, federal and state taxes, and even an estimated amount for utilities and home maintenance. It's the money you have left to buy food, gas, clothes, and handle life's little emergencies. The VA understands that a family living in a high-cost area like San Diego, California needs more leftover cash to live comfortably than a family in a lower-cost area like rural Alabama. A family of 5 needs more than a single individual. So the VA created a chart of minimum residual income requirements that varies based on your family size and the region of the country you live in. For example, a single veteran in the Northeast might need to have at least $490 left over each month. A family of 4 in the South might need $1,092. Your lender will calculate your projected residual income based on your specific situation. As long as your residual income meets or exceeds the VA's minimum threshold for your family size and region, the underwriter has significant leeway to approve your loan, even with the DTI well above that 41% guideline. I have personally seen VA loans get approved with DTIs in the 50s, even pushing 60%, because the veteran had strong residual income. They proved they had more than enough cash flow to live comfortably after the mortgage was paid. This is the heart of the VA loan benefit. It's a holistic, common-sense approach to lending. The VA doesn't just see you as a percentage on a spreadsheet. They look at your real-world financial situation. But that's not all. Even if your DTI is high and your residual income is just barely meeting the minimum, you're not out of the game. The VA allows underwriters to use what are called compensating factors to push a borderline application across the finish line. These are positive elements in your financial profile that help offset the risk of a higher DTI. Think of them as extra credit. What are these powerful compensating factors? One of the biggest is significant cash reserves. If you have 3 to 6 months worth of mortgage payments sitting in a savings account after closing, it shows the lender you can handle an unexpected job loss or a financial emergency without missing a payment. Another is excellent credit history. If you've been a responsible borrower for years with a high credit score, it demonstrates a commitment to paying your bills on time. A history of consistent, long-term employment in the same field also works in your favor. If you're receiving a raise that will take effect shortly after closing, that can be a huge help. Or maybe you're a dual-income household, but you qualified for the loan using only one income. The second income, while not used in the DTI calculation, acts as a safety net and is a massive compensating factor. Even a history of making large rent payments that are similar to or greater than the proposed mortgage payment can be used to prove your ability to handle the new expense. So let's go back to our example. Your DTI was 53%. The 41% guideline is in the rearview mirror. But your lender calculates your residual income and finds you have $1,500 left over each month, well above the $1,092 required for your family of 4 in the South. On top of that, you have $10,000 in your savings account, which is about 5 months of mortgage payments, and you've been at your current duty station for 3 years with a history of steady promotions. What's the verdict? Approved. Without question. The high DTI is completely offset by the strong residual income and the powerful compensating factors. You didn't just meet the standard. You demonstrated a robust ability to repay the loan based on real-world metrics. This is the flexibility and the power of the VA loan. It's not about passing a single rigid test. It's about painting a complete picture of your financial responsibility. So you've navigated the Certificate of Eligibility, you've shined a light on your credit report, and now you've conquered the often feared debt-to-income ratio by understanding its true relationship with residual income. You have all the key financial pieces in place. You're pre-approved. You're ready to go out and find your home. But once you find that perfect house and get your offer accepted, the process isn't over. The VA steps in one last time with a critical requirement that protects both you and the lender. It's a unique type of evaluation that every single property must pass, and it has nothing to do with your finances, but everything to do with the house itself. This final hurdle is the VA appraisal, and more specifically, the VA's minimum property requirements, or MPRs. Forget everything you think you know about a typical appraisal. A standard appraisal is almost entirely focused on one question. What is this house worth? It's about justifying the loan amount for the lender. The VA appraisal does that too, but it goes a critical step further. It asks a second, equally important question. Is this house safe, sound, and sanitary for a veteran and their family to live in? This is the VA's protective shield in action. They aren't just helping you buy a house. They're ensuring you don't buy a lemon. The MPRs are a non-negotiable checklist of standards that a property must meet to be financed with the VA loan. This isn't about whether the kitchen has granite countertops or if the bathroom is outdated. This is about the fundamental health and safety of the home. Think of it as a baseline for decent living conditions, a standard that the Department of Veterans Affairs believes every service member deserves. So, what exactly are they looking for? Let's break down the core components of the minimum property requirements. First, the property must have adequate living space. There's no strict square footage rule, but it needs to have enough room for living, sleeping, cooking, and dining. A shack with no defined rooms won't cut it. Second, and this is a big one, are the mechanical systems. The heating system must be in working order and capable of maintaining a temperature of at least 50 degrees Fahrenheit in any area with plumbing. This prevents pipes from freezing and bursting in colder climates. The electrical system must be safe and sufficient for the home. That means no frayed or exposed wiring. And the system must be able to handle the typical load of a modern household without being a fire hazard. And of course, the plumbing. The property must have a continuous supply of safe drinking water, a water heater that provides hot water, and a sanitary sewage disposal system, whether it's a public sewer or a private septic tank. A house without reliable hot water or a functioning toilet will be an immediate fail. Third, the structural integrity of the home is paramount. The VA appraiser will be looking closely at the foundation. Are there major settlement issues or giant, spidery cracks that suggest the house is unstable? They'll check for any evidence of termite infestation, dry rot, or fungus. These issues can compromise the very bones of a house and must be professionally treated and repaired. The roof is another major checkpoint. It must be in good condition and provide reasonable future utility. This means if the roof is clearly at the end of its life and looks like it could fail at the next major rainstorm, it will need to be repaired or replaced. The appraiser will also check for any signs of water damage or significant moisture in the basement or crawl space, as that can lead to mold and structural decay. Fourth is access. The property must have safe and legal access from a public or private street. You can't get a VA loan for a cabin that you can only get to by crossing a neighbor's land without a permanent, legal easement. The access must be all-weather. meaning a muddy dirt path that becomes impassable in the rain won't qualify. I remember a story about a Marine veteran in North Carolina. He found what he thought was his dream home, a beautiful older farmhouse on a few acres. It looked perfect. The price was right, he was pre-approved, everything was lining up. The VA appraiser went out, and at first glance things looked good. But his trained eye caught something subtle. A slight, almost imperceptible dip in the floor in one corner of the living room. He went into the crawl space with a flashlight and found what the home inspector had missed. A main support beam was almost completely rotted through due to a slow long-term leak that had been painted over. The cost to repair it was going to be over $20,000. The seller refused to fix it. The VA appraisal saved that veteran from buying a home that was on the verge of a catastrophic structural failure. He was disappointed at the time, but a year later, in a much safer home, he realized that MPR wasn't a roadblock. It was a guardrail that saved his family from financial disaster. That's the power of this requirement. It forces issues to the surface before you sign on the dotted line. So what happens if the appraiser finds problems? Does it kill the deal? Not necessarily. This is where the process becomes a negotiation. The appraiser will complete the appraisal but make it subject to certain repairs. He or she will issue a document called the Notice of Value, or NOV, which will list the property's appraised value and detail every single repair that must be completed for the loan to be approved. From there you have options. The most common scenario is that you take this list back to the seller. You can negotiate for the seller to pay for and complete all the required repairs before the closing date. In a buyer's market, most sellers will agree to this to save the deal. Your second option is that you can pay for the repairs yourself, but this can be complicated and isn't always allowed by lenders. A third option is to renegotiate the price. If the repairs cost $10,000, you might ask the seller to drop the home's price by that amount, allowing you to use your own cash after closing to fix the issues. And finally, if the seller refuses to make repairs and you can't or don't want to, you can walk away from the deal. Because the financing is contingent on the property meeting VA standards, you will almost always get your earnest money deposit back. The MPRs give you a built-in exit strategy from a bad investment. This entire process from start to finish, from the Certificate of Eligibility we talked about in the beginning to this final property inspection, is designed with one person in mind, you, the veteran. Think about the journey we've covered. We started with proving your service to get your COE. We moved on to the lender's requirements, the credit scores and financial stability they need to see. We dove deep into the numbers, demystifying the debt-to-income ratio and explaining the VA's secret weapon for affordability, residual income. We clarified the VA funding fee, explaining who pays it, why it exists, and who is exempt. And now we've seen how the VA stays involved right to the end, protecting you from a bad property with its minimum property requirements. Each of these steps is a checkpoint, a layer of security. They might seem like hoops to jump through, but they are a framework for success. The VA home loan isn't a handout, it's a hand up. It's arguably the most powerful and beneficial home loan program on the market, a tangible thank you for your service and sacrifice. It's a benefit you have earned through your commitment to this country. The path to homeownership can feel overwhelming. There's jargon, paperwork, and moments of doubt. But you have navigated far more difficult challenges in your service. This is just another mission. Your mission is to understand the rules of engagement, assemble your team, a knowledgeable lender, a great real estate agent, and execute the plan. You have the tools, you have the knowledge, and you have an entire system, established by a grateful nation, ready to back you up. This isn't just about qualifying for a loan. It's about securing a piece of the nation you swore to protect. It's about building a future, creating a home and planting roots. It's the American dream, and you more than anyone have earned your right to it. So take this information, take this confidence, and go make it a reality.